Hi, welcome to the ACCA F5 online session. I'm Hafeez as usual, and I'm going to take you through to the divisional performance evaluation. As you are familiar that we have covered one area which was the last session, and we were talking about the corporate performance, and we had a look at some of the ratios. By doing the ratio analysis, we assessed how the business was performing. Now it is segmental performance in this session, okay, which is part of the syllabus and actually quite important over the recent few sittings. Segmental performance is simply we look into the divisions or branches or departments of the organizations, and then by applying some of the criteria, we assess whether the divisional managers have done good job or divisional managers have not done good job. Okay, whether the departments were performing as per the benchmarks of the company or head office, or the departments were not performing accordingly. So this is about the divisional performance. Let's get started. Okay, before we look into details of measuring the divisional performance, first of all, a couple of minutes to understand why divisionalization is important. Understanding is divisionalization refers to dividing the organization into different divisions, departments or branches, and delegating responsibilities to the heads of those divisions or departmental managers. So top management delegates some of the responsibilities to the divisional managers so that divisional managers can feel they are part of the organization, not just as an employee, but they are making decisions like that's their own business. So in order to motivate divisional managers, responsibilities are given to the divisional managers. And that actually helps them to achieve the results in the best possible way. A number of people feel that because of divisionalization, most of the managers are considered to be at a race, that division A should perform better than division B, and this self-motivation encourages the managers to perform better and better and better. Now, understanding of divisionalization or divisional performance is that performance of the divisional managers should be based upon the responsibilities or benchmarks assigned over to them. If those targets or benchmarks are met by the managers, it simply refers to a good performance. But if the managers could not achieve those targets, benchmarks or yardsticks, then we consider the managers have underperformed. Now here are some of the methods we use in order to assess the divisional performance. First of all, first measure is called as return on investment, which you might have seen it many times in other papers and generally in life as well, which is simply profit before interest and tax divided by capital employed or investment. There are different expressions used: capital employed or investment, or sometime in exams it's written as net assets. Net assets. Profit before interest and tax, or PBIT, or sometimes it's called as controllable profit in the exams. Now, keeping in mind, this is only that value of the profit which is generated purely by the divisional policies, that the head of the division has decided, head of the division has generated sales, head of the division has incurred cost, and head of the division has incurred expenses. So whatever the revenue and costs are generated or incurred in the division, only those elements are included in profit before interest and tax calculation. Therefore, any interest or any tax is not responsibility of the division. That's the responsibility of the head office. So we only look at that element of profit which is controllable by the divisional manager, okay, that his or her decisions are having an impact on the profit. Well, he doesn't have any impact on the interest and tax of the company. Okay, so remember, always profit before interest and tax or controllable profit. We do not consider any head office policies or head office expenditures or head office costs, only purely divisional revenue and divisional costs and expenses. What we believe is greater the better idea for return on investment. So there are two ways we can look at whether ROI, return on investment, is good or otherwise. Number one, it is based upon, it is compared with head office target ROI or return on investment, and number two, based upon greater the better. Meaning, if this year ROI is better than last year, it shows improvement. It shows better performance than last year. Okay, we will have a look at this ROI in a minute. Second criterion is residual income. Residual income formula you can see, which is return profit before interest and tax, which is return profit before interest and tax minus capital employed into cost of capital, and this cost of capital is always given to us as a percentage. We don't need to calculate cost of capital because in this syllabus it will be given to us. Now, understanding what is residual income. Okay, if answer of residual income is positive, then divisional performance has been good based on RI, or if it is negative, then the performance is not good, performance is poor. Okay, so on its own we can judge whether residual income is good or bad for each division, and thus the performance is good or bad. Okay, let's understand what do we mean by this. If we look at the information within the brackets, capital employed times by cost of capital, what are we trying to say here is, some people believe, some management experts or accountants, they believe that capital employed times by cost of capital simply reflects an opportunity cost. Opportunity cost simply means that if there were any other investments available in the market, if there were any other projects available in the market, or there were any other opportunities available in the market, and we had invested in one of them, how much money we could have generated from other investments available in the market. So what we do is we compare. If the profit before interest and tax generated by the division is greater than any other opportunity in the market, it means our decisions were correct. It means our investment was appropriate. But if we have generated profit before interest and tax for this division which is lower than other investment opportunities, it means we haven't invested in the right place, or our decisions were not appropriate. Second version of the same thing, some people interpret this information within the bracket capital employed times by cost of capital in a slightly different way. They consider it is a borrowing cost. Borrowing cost is this, that if we had borrowed all our capital employed, for example, if we were funding our division from a borrowed money, from the borrowings we know that we have to pay interest, finance charges or interest. So question is, if our profit before interest and tax is sufficient to cover these borrowing costs or interest and finance charges, it means our profit is sufficient, and it is treated as value addition. But if our profit before interest and tax of the division is less than the borrowing cost or interest on capital employed, then it simply reflects non-value addition, that we are not generating enough residual income and actually we can't even cover the borrowing cost. Okay, so in either way residual income has to be positive. Okay, let's have a look at a question. Okay, Example, Tonic Limited. There are two divisions with the following performance for the current year. We are given two divisions X and Y. Investment in X is $10 million and investment in Y is $30 million. Okay. The controllable profit of division X is $2 million and Y is $3 million. Y is slightly larger division than X. Required rate of return is 15% and required by who? By the head office. So head office target, head office always requires these, sets these targets. So required rate of return or ROI set by the head office is 15% and assumed cost of capital is also 15%. Generally it is lower than ROI, but let's see as a question. Now requirements, calculate the performance of each division based on ROI and then RI and which division has the superior performance. So here we go. Let's have a look at the example Tonic Limited. First of all, let's calculate the return on investment. And remember the formula, profit before interest and tax or controllable profit divided by investment or capital employed. And if we multiply this by 100%, we get answer expressed as a percentage. So there are two divisions, let's deal with them one by one. First of all, division X and then division Y. Profit of division X is given, you can see here, $2 million. And investment of division X is $10 million. Times by 100, we will get something like 20% ROI of division X. Likewise, we can do the same method for division Y. Net profit generated or profit before interest and tax generated is $3 million, controllable profit, divided by $30 million, which is the value of capital employed or investment, and that gives us 10%. Okay. Now, it looks like on the face of it, as you can see very clearly, division X has superior performance than division Y. And it's not only due to the fact that division X is generating 20%, which is twice the ROI of division Y. Not only is this reason. Main reason is division X has achieved the head office required rate of return, which is 15%. So division X has superior performance than Y simply because division X has performed better than head office target of 15%. And division Y has inferior performance or poor performance not because it got less than X, division X only, simply because it has not been able to achieve the head office target of 15% and therefore division Y has underperformed. Okay, so please remember, we don't compare just division X with Y. It's like, this is my silly example, so please don't get me wrong about this. What do you think if there are two students, they go to the paper F5 or F6, F7, any papers of ACCA. They go to the ACCA exam and one fails with 40 marks and another fails with 45 marks. Now the question is, who is better than the other? Somebody failing with 45 marks and somebody failing with 40 marks. Which one is better than the other? Can we say that person who got 45 is better than somebody who got 40? And you'll be smiling, no way, because both still have failed the paper. Both could not reach the break even of 50%. Okay, so the first thing is we need to see whether the divisions have achieved the head office target or not. Once they have achieved the head office target, then we can compare with each other. Oh, X is better than Y because of higher return on investment. Okay, so first of all is the head office target you have to see while comparing or assessing the performance. And if this criterion is met, job done, division X has performed better than Y. Okay, so the things I was explaining in exams you have to write down. Okay, apart from my silly examples, everything else you will write down when you will explain the performance. Now we are looking at the residual income. Second criterion is residual income, which is RI. Okay, and the formula, just to remind myself, profit before interest and tax minus investment or capital employed times by cost of capital. And cost of capital is given as a percentage. Okay, now let's do it for divisions X and Y one by one. Okay, so RI of division X. First of all, the profit, which is $2 million, minus investment, which is $10 million, times by cost of capital, which is 15%, and we end up with residual income for division X, which is going to be, I think, $0.5 million. And on the calculator, you can check when you solve it, you should be able to get a positive 0.5. Now I am looking at division Y. Okay, $3 million of profit before interest and tax, or controllable profit, minus investment in division Y, which is $30 million, multiplied by 15%, which is cost of capital given in the question, and we end up with $1.5 million negative. Okay, the answer comes out as minus or negative, and based upon residual income criterion, division X has performed well simply by adding value to the whole organization. Simply by adding value to the whole organization, the division X is giving $0.5 million to the head office, that here is our contribution. Whereas division Y has a bad or poor or inferior performance simply because division Y is contributing non-value addition. It is adding $1.5 million of loss to the overall organization. Okay, and therefore they consider that division X has performed better than division Y. Okay, I'm not talking about in real sense profit or loss. I'm talking about in terms of value addition or non-value addition. Okay, that $3 million profit they have generated, 3 million profit is nice, but $3 million profit was just not sufficient. They should have earned more than that. Okay, and that's the understanding of residual income, whether they have generated enough profit or not enough profit. So X has performed better than division Y on the basis of residual income. Positive means good and negative means poor or bad. Okay, now these were the results we seen based upon return on investment and residual income. It hasn't finished yet. Here we go. Let's have a look at the example, same example continued. Now before I look at this example continued, keep in mind please one thing. In any organization, only one criterion is used at a time to assess the performance of the managers. If we are using return on investment, then we are not using residual income at the same time. If we are using residual income as a performance measure or criterion, then ROI is not used parallel. Okay, only either return on investment or residual income, one of the two are used at a time to measure the performance of divisional managers. Please keep in mind, because in this case it was fine that using both criteria division X performed better than Y, but in a number of cases it happens that both criteria conflict with each other. Okay, return on investment may give us one opinion and residual income may give us another opinion. So in order to avoid these conflicts, we only use one method, whichever we prefer. Here is the continued example, which is Tonic Limited. Continuing from the previous example, each division has the opportunity to invest in a new project. Now they are looking to invest in a new project like expansion of division X and expansion of division Y. Okay. So understanding is, should they expand division X or not? Should they expand division Y or not? So they are looking at a new project for division X and division Y to expand them. Details of the new project are given that it requires investment of $500,000, which will generate profit of $80,000. And Y is $1 million investment or $1,000 and $120,000 of controllable profit. A required rate of return set by the head office is again 15% and assumed cost of capital is again 15%. Using the measures of performance above, which measures? ROI and residual income. Using the same measures of performance above, assess the decisions that would be made by divisional managers. What decisions? That if head office is presenting these new projects, expansion projects in front of divisions X and Y, whether divisional managers would like to take up these projects, whether they will be interested to expand or not. Number 2B, which is head office, how head office will feel about whether head office likes to expand division X or head office likes to expand division Y or otherwise. And C, whether these decisions are congruent with each other. Goal congruency is this. Goal congruency simply reflects making decisions which are in the best interest of the whole organization, reaching to those conclusions which serve in the best interest of the shareholders or the company as a whole. Okay? Now here the meaning is whether the decisions are congruent with each other in this way, that if the manager of division X says, I do not like the project, I do not like the new project, what head office thinks? If head office says the same thing, yes, you are right, we do not like this expansion, then these decisions are goal congruent. But if the divisional manager of X says, I do not like the project, and the head office says, oh no, you are wrong, this is a very nice project for our company, we need to take up this project, then this creates dysfunctional behavior or conflict between head office and the managers. So let's assess whether divisional managers will like these new projects or otherwise. Head office will like these new projects or otherwise. Okay, so first of all, I am looking at the ROI, okay, of division X and then division Y. If I double check the numbers, 80 divided by 500, or if you fancy 80,000 divided by 500,000 full values, and we get the ROI of division X as, here is my calculator, 80 over 500, which is 16%. Okay. Then division Y, $120,000 divided by $1 million times by 100%, and we get approximately 12% ROI of divisions X and Y respectively. Okay, now here is a question. What do you think? If you put yourself in the shoes of divisional manager of X, that you are the manager of division X, head of division X, would you like to invest in this new project which ends up with ROI of 16%? Would you like to take it up? I can hear some people are saying yes and some people are saying no. Same thing. Now put yourself in the shoes of head of division Y and see, would you like to take up this new opportunity which generates 12% ROI? Again, I can hear some people are saying yes and some people are saying no. Well, idea is simply this. When the divisional managers, now we are assessing based upon divisional managers. That how divisional managers will look at these ROIs. So please remember, divisional managers, a number of times, you don't need to agree with me, but it is the human nature. Generally, we compare our performances with the previous performances. If we are improving or if we are performing better than the past, we feel we are improving things. But if we are going worse than in the past, for example, sales were 1,000 units in the past, and if sales are 1,500 units now, we feel we have done better than before. But if sales were 1,000 in the past and now sales are only 700, we feel, oh, probably, we haven't done the right job. We haven't adopted the right strategies. Managers always compare their performance with their past performance. Now remember, divisional manager X already had the past ROI was 20%, and divisional manager will think, oh, hang on a moment, before I was having 20% ROI and now I'm only having 16%, and this new project will cause a reduction in ROI of my division, and therefore the divisional manager X will reject it. Simply because it is causing a reduction in their previous performance. They will not care about what the head office ROI is. I knew some people were saying yes, accept it, because they were looking at the head office point of view. No, think about the manager point of view, that you are the manager of division X and you are taking up a new project which is generating 16%, and hold on a moment, you already had achieved 20% in the past, so which is like a benchmark for you. So now you will not accept any project which generates less than 20%. You will like to invest somewhere which is giving you better than before, or at least 20%, so that your performance doesn't go down. Likewise, if divisional manager Y is looking at the previous performance which was only 10%, and can you not see divisional manager Y can easily justify that, oh, it looks like an improvement. Head office target is 15%, last time I had 10%, now I have got 12%, so it shows gradual improvement, and very soon if I keep on investing in the projects like this, I may be able to achieve head office target of 15%. And that's how people consider. Managers compare with their past performance, okay, and they are likely to accept the project based upon ROI. So one manager may reject, another manager may accept. Is it okay? Right? Let's have a look at B. B is from the head office point of view. That now put yourself in head office, that you are working for the head office. What do you think? Head office target is 15%, and division X has achieved 16% on the new project, and head office will compare with target 15%, and for the head office it is still fine long as it generates more than benchmark of 15%. Head office is more likely to go ahead with this project. So head office may accept it simply because it is still 1 percentage point better than the target, whereas head office may likely to reject expansion in division Y because 12% is still below than 15% and head office target has not been achieved. Okay, so This is now what we look at dysfunctional behavior, that by using ROI, both parties could not reach to a same conclusion. One manager was saying go ahead, another was saying no. Head office was taking one step further for one project and going back from another project. So that creates conflict or dysfunctional behavior. Dysfunctional behavior when the managers or head office could not reach to the same platform. Okay. Now we are looking at the return on residual income. So using ROI, the decisions were not congruent to each other. Now we are looking at the residual income point of view. Okay, same formulae. Here is division X, here is division Y. Okay, 80,000 minus 500,000 times by 15%, and RI of division X comes to I think 5,000, just let me double check. Yes, $5,000, and that's positive on my calculator. Whereas division Y, 120,000 profit before interest and tax minus investment, which is $1 million, times by 15% as cost of capital, and that gives us, I think, $30,000 being negative residual income, minus residual income. Okay. Now here is, I am the manager of the division. Decide from the manager point of view. I am the manager of division X. Now being positive RI, I am likely to accept this investment, whereas being negative RI or non-value addition, I may discourage this investment opportunity simply because it is adding to my problems. I already had a negative residual income, and with this new project I will contribute more non-value addition, so I will resist that. It's not very good for me. Now head office point of view. Head office thinks the same way, that it is value addition, so let's accept it because RI is positive. And head office will also reject division Y's new investment simply being non-value addition, that it is negative RI, so let's not go for expansion in division Y in this new project. Let's think about something else. Okay, and I think now we have reached goal congruency. Whatever the managers were deciding, head office was deciding exactly the same thing, and now we can see in requirement C, both decisions are goal congruent, that both are heading towards the common interest of the organization. Okay, now we are looking at the next area of the thing, which is behavioral issues. Understanding is, a number of times it happens that, you noticed that division X had positive residual income, division Y had negative residual income. Division X had more than head office rate of return, and division Y had less than head office rate of return. And that can cause demotivation among some managers, that we are probably trying our best and we are still not achieving. So what some people do, because it's a human behavior, you don't need to agree with what I'm talking about, but we are humans. A number of times saving the skin idea is applied by many managers. Saving the skin is this, that whatever we are doing, long as at the end of the day, at the end of the year, if the management appreciates me, if the management appreciates my work, if the management likes my policies, I feel happy. Now, in order to achieve the head office targets, a number of unethical approaches may be adopted by the managers, and that's why you study one paper, which is audit. Okay, that by looking at investigative ideas, you try to find out if there is any manipulation, if there is any overestimation, underestimation, if there is any fraudulent element and so on, so that you can make sure these financial statements are true and fair. Okay, so a number of times divisional managers overstate the profits in order to get better residual income, in order to get better return on investment. Okay, here are some of the simple ways to overstate the profits. Phasing of apportioned cost to charge fewer costs during the period, meaning to say is work out that type of overhead costs which are going to go low or less into the products. Okay, phase them out, put some in here, some in there, and long as you achieve the results, you feel okay. Revenue recognition of sales in previous periods or future periods, so manipulating the cutoff date. Okay, sometimes here or sometimes there, meaning a number of people, they are criticized about this, that at the end of the year, generally at the end of the year, if they have seen that they have achieved the ROI as per target in November or early December, they stop booking more sales in December. So they put the invoices, they book invoices January next year, so that next year can be more comfortable. Again, manipulation, it's unethical. Ignoring part of cost base. Incorporate sales from other divisions, double count sales, and not only this one, manipulating depreciation policies. If you are using one depreciation policy, change depreciation policy so that your return on investment can be improved. Okay, or use of older assets. Why use of older assets? Because if you are using older assets, they are not being depreciated. And number two, the investment value keeps going down. And if the investment goes down, both ROI and RI become positive or better for the division. Okay, so a number of unethical approaches may be applied. So again, as I said, of course, you are nice people, but a number of managers try to do it in order to get better results to achieve the target. Okay. Now the last area of the syllabus is transfer pricing, which is part of the divisional performance. Okay, so let's have a look what transfer price is. Transfer price is simply an internal price between two divisions. Internal price between two divisions, meaning within one organization, if one division is supplying some materials, components, or any ingredients to another division, supplying division becomes selling division and buying division becomes purchasing division or buying division. And in the transfer of goods, if any price is paid and received, that becomes transfer price or internal price. Question arises, why transfer price? Okay, why transfer price? So there are three main reasons for the transfer pricing. Why to charge transfer price in the first place? Because remember, both divisions are part of the same organization. So if they are part of the same organization, why the price? It's like this, the goods are moving from this room to next room. Why the price? And here are the reasons why the price, why transfer price. Number one, for performance evaluation. Remember, we calculate return on investment and residual income to measure the performance of the divisions. And both return on investment and residual income have a starting point of profit before interest and tax. And if there is no selling price, then how are we going to get the profit? So that's why we charge the selling price, so that we can achieve some profit. Number 2, global tax. Global tax issues. In a number of cases, it may happen that one division is lying in the UK and another division may be lying in France. Another division may be lying in India, or another division may be lying in China. So the question arises, every country has their own tax rules. Okay, so when the goods are transferred from India to UK or UK to the China, then of course different tax situations are adopted. So in papers F6 or P6, you are going to have a look at these tax issues which are not part of our syllabus. And thirdly, to record movement of goods. To record movement of goods, okay, which is going to be covered in paper F7 and I suppose P2, not in this course. Okay, when the goods are transferred from parent to subsidiary or subsidiary to parent, then these type of things are covered in there. So our aim or focus is only on the performance evaluation, which is part of F5. Different papers, different aims, okay, right, for performance evaluation. Now there are a number of methods which are part of the syllabus, okay. Here are the transfer pricing methods. Number 1 is external market price. External market price is simply based upon charging the buying division just like you are charging the external customer. And generally the price charged is quite high. Then the next few are the cost based. Okay, and cost based are generally low priced. Generally it happens in number of industries that external market price is charged to the buying division when there is an external market existence, that if buying division doesn't buy our components, we don't care, we can sell them easily and comfortably outside the organization. But cost based approaches work in those industries where there are compatibility issues and the supplying division cannot sell these components, hardwares or softwares to any other company but to this buying division. Okay, right. And the third one we are going to talk about, which is going to be, 1 minute we can talk about here. You may say in here, may not be acceptable to buying division because external price is quite high and the buying division may not like this price. Okay, whereas cost based approach may not be acceptable to selling division, supplying division, simply because cost based is low price, and because of low price they may not achieve required profits or required return on investment, and that creates a little bit conflict between the two divisions, that one department is not accepting this approach, another division is not accepting another approach, and then the head office may intervene to deal with these two things. Okay, and the head office aim, by the way, if I ask you, do you think head office likes a higher transfer price or lower transfer price? And I think you are telling me head office does not care which price we charge. What head office cares about is that this price should work in the best interest of the company as a whole. Meaning to say, head office doesn't care high or low price, because whether the money leaves this pocket and money comes this pocket, money still remains within the same company. So that's why company doesn't really care, head office doesn't really care. Head office cares one thing, that the price should be optimum, which is appreciated by supplying division, which is happily accepted by the buying division, and this price should work in the best interest of the company for the shareholders. Okay, now let's have a look at an exercise here. Exercise number 3, transfer pricing. Okay, requirement A is, if we look at the requirements first, calculate ROI for each division and comment briefly on the performance of each. Okay, so let's have a look at information. Furniture company manufactures and sells luxury couches. Each couch is produced using a standard frame and other covering materials. Within the company, Division R manufactures the standard frames which are then sold on to Division S as well as to external customers. Division S produces fully completed couches which are sold to external customers only. So R is a supplying division, S is a buying division. Both of the divisions have performance assessed based on return on investment, ROI. The required rate of return is 15%. Required ROI is 15% set by the head office. Now we are given financial statements or income statements of each division R and S. And requirement A is calculate the ROI for each division and then comment briefly on the performance. Now ROI, remember the formula, controllable profit divided by investment or divisional net assets. So here is transfer pricing, requirement A. So ROI of division R and then division S. Okay, so let's pick the numbers up. 1,900. It's in millions of dollars, but I'm ignoring 3 zeros. Divided by 10,000 times 100, and the other one is 1,060 divided by 7,800 times 100, and here we go, we get approximately 19% ROI for division R, and 1060 divided by 7,800, we get approximately 13.6. Just let me double check. Yes, 13.5 or 13.6. And it looks like as the head office target of 15% has been achieved by division R, reflects good performance. But as the head office target of 15% could not be achieved by division S, so division S has underperformed or performance was poor. That's the brief comments. Now we are looking at the second requirement. Okay, and then we will see how transfer pricing policies affect. Explain how transfer pricing policies may result in managers making or taking decisions which are not in the best interest of the company, and recommend a suitable transfer price for Furniture Limited. Okay, now understanding is this. At the moment, if you look at the information provided here, okay, at the moment, if you look at the internal sales of division R, 1800, you would find exactly the same thing, 1800 under division S, because R is selling, so we are recording this as sales, and S is purchasing, and we are recording this under the purchases of S. So the issue is simply this, that division R is charging $900 transfer price to division S. And the problem it can create is this, external price is also $900, meaning division R is treating division S just like an external customer. Okay, just like an external customer. So idea is that if division S stops buying goods from division R, for example, if division S says, I'm not interested to buy these things from you, okay, I'm rather gonna go somewhere else and I will buy from somewhere else, and that can cause a problem. Okay, that can cause a problem. So recommended suitable price will be a range, okay, that division R should consider what should be acceptable. Okay, but we needed some more details, therefore we will answer this at the end. Now here is the requirement C, okay, and then we will see how these managers cannot make the decisions which may not be working in the best interest of the company as a whole. The transfer price was established a number of years ago, and head office will only allow division C to purchase the frames from division R. Although the manager of division S believes the frame could be purchased externally for $825, and this is what I was highlighting before because I needed some more information. That's why I couldn't complete requirement B, because I knew I needed more information. Okay, information is this, that now S can easily buy the same frame for $825, and why S should pay $900 then? I mean, logical question in the head of manager of S, that my performance is 13.6% only and I am being criticized for my poor performance. So let's forget about division R, let's go outside and buy for $825. Now here is an overall B and C I'm answering together. Okay, requirement C is calculate divisional and total company profits if division S is allowed to purchase the frames externally. Okay, now here is requirement B, recommend a suitable transfer price. Suitable transfer price is this, that if division S pays same 825 to division R, okay, let's see if division R accepts. Okay, so here are the profit statements. Mostly it will remain the same if R accepts transfer price of 825. Okay, so here is the division R in thousands of dollars, here is division S in thousands of dollars. First of all, external sales, which will remain the same, $4,500, $5,300. Then internal sales. Now the new price is 825. Okay, so 825 times 2,000, that's 1,650, and that becomes cost for the other division. Okay, now we are just going to copy and paste everything. Variable costs, I'm just going to copy and paste 2,100, and here is 1,800. Okay, please look at this. I'm just copying and pasting all numbers because rest of the cost will remain the same. Fixed costs, fixed production, 1,400, and here it was 600. Okay, here is selling and distribution variable, 500, and for the other one it is 240. And fixed selling and distribution 400 and 200, And here is the resulting profits, revised profits, if division R accepts the transfer price of 825, because otherwise there is a fear that S may go outside the company. Okay, so R reduces the transfer price from 900 to 825. Originally it was 900, and they reduce from 900 to 825 to match the other supplier's price. So here is these profits of each division. $1,750, and S is 5,300 minus 1,650 minus 1,800 minus 600 minus 240 minus 200. Oh, sorry, one thing I have added which was wrong. Okay, other materials 1,400. This was my mistake. By mistake I put down 1,800, but it was 1,400 other materials. Okay, that's why I was thinking why it is less profit. So let me do it again. 5,300 minus 1,650 minus 1,400 minus 600 minus 240 minus 200, and it comes to 1,210. Okay, and let's see if both divisions will be happy about this. Let's calculate the ROI. 1,750 divided by 10,000 times 100, and we get 17.5%, and division R will accept it because it's still better than head office of 15%. 1,210 over 7,800 times by 100, and now it is 15.5%, and division S will be quite pleased with this information because 15% ROI is achieved. Okay, and company as a whole, if I look at the profits, 1,750 plus 1,210, the total head office profits will be the sum of the two, 1,750 plus 1,210, 2,960. And originally if I look at that, when the transfer price was 900, can you see profits were 1,900 plus 1,060, and that was the same 2,960. So it doesn't make any difference to the head office. Okay, requirement C was calculate if S goes outside the company, how it will change the results. So now we only are going to calculate profits of R if S stops buying from division R. That if R rejects this price, for example, it's both ways. R may say, no, I'm not interested in less than 900. So R may reject it, and as a result, S may go outside the company and they will stop buying from R. So here is the profits in thousands of dollars. Okay, external sales will remain the same, which are 4,500. There will be no internal sales, goes down to 0 because S goes outside. Then variable production cost. Okay, you can look at the question. which is at the rate of 300 times by 5,000, which is 1,500, and anything else will remain the same. Fixed 1,400, variable selling and distribution 500, and fixed selling and distribution 400. And here is the revised profit if S stops buying from R. 4,500 minus 1,500 minus 1,400 minus 500 and 400, the revised profit will be only $700. Okay, and R will be quite displeased with this information that this couldn't achieve the head office target, because 700 simply represents ROI of 7%. Head office will not be pleased with this information, because 700 plus 1,210, the head office profits will decrease by more than $1 million, and therefore head office will not like this approach. Head office will rather prefer that division R reduces the selling price from 900 to 825 to achieve this. Okay, so based upon this, we can say here that in the best interest of the company as a whole, they should have used the common or goal congruence idea that let's do whatever is in the best interest of the company as a whole. Okay, charge a price of 825, which is acceptable to division S and okay for division R as well, because the head office targets are achieved and everybody is a happy bunny. Okay, so this was about transfer pricing. Please revise it, and any issues, come back to us. Mail my tutor. Okay, thank you so very much for your time and patience. Take care. Goodbye.